Let's spend a little bit of time talking about current liabilities. Now, I have an excerpt here from a company, and this is not a publicly traded company. It's a family-owned business, but still large enough to have $2.5 million in current liabilities. And I selected this financial statement excerpt on purpose because it has one current liability that we don't often see in companies. I mean, some of these, if you've been studying accounting for a little while, make a lot of sense probably. You probably understand that accounts payable, well, accounts payable trade is amounts due to our vendors and our suppliers, so to external parties. It does look like we have some kind of other accounts payable, not highly material. It's only 120 grand at the end of 2017. But it's still something. And we would have to consult the notes to the financial statements to get a little bit more information about what that other payable of $120,000 really represents. But you guys know what accounts payable is most likely. And you probably understand accrued expenses. I mean, accrued expenses, sometimes these get listed as payables, like wages payable or interest payable. But whether we're using the terminology of accrued or payable, what we're seeing right here is these are expenses that the company has incurred but not yet paid. Okay? So wages and bonuses as an example here. This $95,000, it's due to our employees. We owe it to them. We just have not paid it to them. In fact, they earned it during 2017. That $95,596 is part of a calculation that we use to determine what a complete payroll expense should have been for the year ended 2017. And the amount that we owe them is right there. The same is true for the property taxes and for the interest. These are all current liabilities. But there's one up here that you may or may not have seen before. Checks drawn on future deposits. Now, what that is, that's actually credit balance cash accounts, negative cash, okay? This is where a company has written checks in advance in excess of the funds that they have in their checking account. So it's an overdraft. Now, there's some debate about how to present this, but as generally conceived, I've seen companies reclassify this negative asset to a current liability. So in other words, you could still have your balance sheet balance if you showed cash as negative $319,000. But it's not quite as meaningful. So most of the time what we see is we see a reclassification where that negative asset becomes a positive liability, and we depict this as a current liability called checks drawn on future deposits, or we use some kind of caption that is descriptive in that manner. Let's take a look at a couple of accounts payable transactions. Now, on the surface, accounts payable is not incredibly complicated because accounts payable is a liability account. It increases with a credit entry, and if we want to make that account decrease, we make a debit entry. Those are the rules for liabilities. What's going to happen is when we make that credit entry to accounts payable to make it go up, there's going to be a corresponding debit or potentially debits to expense and or asset accounts to recognize the items or the services that we purchase. So let's just take a look at a transaction here. We've got a company that received this invoice. So what's happening here is this company was in the construction process for a new kitchen for a new restaurant, and Laker Pizza LLC is the name of the company that's purchasing something. Capstone Construction is the name of the construction company. So what we're seeing here is Laker Pizza has received an invoice from Capstone Construction. Invoice is dated June 15. We have the invoice number. We have the address over here and then a description. One automatic fire suppression system installed to the kitchen hood, and some other details, of course. Total due is $3,225. Please pay this invoice net 30 days. You see, those terms are important. This is the vendor, Capstone Construction, is telling Laker Pizza that we want you to pay this invoice within 30 days. Of course, you can pay it sooner, but don't pay it after 30 days. And thank you for your business. So let's just look at the two entries here. On June 15, The kitchen hood is installed. Now, we have a dollar amount of $303,225. Right there. I'm putting our debits and credits here. Sometimes it can be helpful to lay it out this way. It's certainly only one of a few possible ways, but I know we're going to make a debit entry to something and a credit entry to something. So I start to ask myself, what do I debit? What do I credit? Well, I know that accounts payable is going to go up, so why not list that current liability as our credit entry? Because we owe $3,225 to Capstone Construction. Now the question is, what do we debit? Well, it could be an expense, but in this case, what we're seeing is a capital asset. Capital asset is a long-term asset. It has benefits that extend beyond the future, into the future, beyond the current period. This range hood with a fire suppression system, this fire suppression system should last for many, many years. So what I'm going to do is I'm actually going to debit this to an asset account, and I'm going to call it equipment. Okay, kitchen equipment, something like that. And then down the road, not in this lecture, but maybe at the end of the year, we will calculate the depreciation expense on this equipment, and then we'll start to record some accumulated depreciation as well. But our vendor doesn't care about that. They don't care about what depreciation method or life we choose. What they want to do is they want to see the money. So we're going to follow their wishes. Please pay this invoice net in 30 days. So a month later, on July 15, let's start out with a couple of amounts here. It's the $3,225 again. But what we're seeing here now is you're asking yourself, what's going up, what's going down? Anytime you're constructing a journal entry, ask yourself, what accounts are being affected, and are they increasing or decreasing? These are the fundamental questions. Well, I can tell you one thing. If we are paying our vendor, cash is guaranteed to go down. Well, I guess I shouldn't say guaranteed, but most likely. I don't think your vendor wants to get paid in any other asset except cash. So cash decreases, and then actually accounts payable decreases. So what you see here, when we incurred the liability, we increased accounts payable with a credit. Later on, when we pay the liability, we get rid of that accounts payable, we decrease the account with a debit. And of course, our cash goes down too. Here's another example of an accounts payable transaction, but this one involves a potential discount. So we have an invoice, and we're doing the accounting for Resort Partners, LLC. So this is a company that operates a vacation rental in northern Michigan, and Resort Partners has received a propane invoice from Campus North Oil Company. Okay, so refill the propane tank. Let's look at some of the details here. Now, it may be a little difficult to see, but the date of this invoice is March 27, 2019. So that's the delivery date when they delivered, 130 some gallons of propane to our resort. And the invoice total down here is $279.35. I'm just going to recap that because it might be a little bit difficult to see. Okay, now, but there's something important, and I can't circle it here, but I want to point out here this terms. It says 2% 10 days, net 30. Okay, so these terms, and I'm going to recap that right down here. 210 net 30. And what that's basically saying is, if we pay this invoice very quickly, if we pay it within 10 days, we can take a 2% discount. If we want to wait 30 days, but not longer, if we want to wait 30 days, then we're supposed to remit the entire $279.35. The initial transaction is not particularly difficult to record. So March 27, and of course, we're probably not actually making this journal entry on March 27. There's a good chance that we're sitting at the computer entering this invoice sometime in early April. But we're going to date it March 27 because that is the date that we received the propane. And so in this case, we're going to just keep things simple. And I'm going to debit an account called Utilities Expense because we certainly did incur an expense. keeping that rental place heated and keep the appliances running. And then we make a credit entry to accounts payable. And we're going to run out of space a little bit there, but I bet you can work with me. We can see it happening. Debit expense, credit accounts payable. Now, what if we accept the discount? Okay, so just a few days later, okay, we decide to accept their discount. Okay, well, the total amount that we owe them is $279.35. 2% of that amount is $559. So, in other words, if we accept their offer of a 2% discount, if we pay quickly within 10 days, we can save $5.59. What that means is that we don't have to pay them $279. We're going to pay them $273 and some change. So let's construct that journal entry. I'm going to put the debit to cash, pardon me, I misspoke. The credit to cash. I'm going to put that in the journal entry first, just because I want to illustrate that we're spending $273 to satisfy a liability of $279. Now, you might be thinking ahead of me, possibly. We know that cash is going to go down. The other thing that's going to go down is accounts payable, because I'll tell you what, we don't owe any money to that vendor anymore. Once we've made payment in full, that liability goes away. The liability we created here with a credit gets completely erased. Now, the savvy students out there watching, you're saying, but Harper, debits don't equal credits here. And you're absolutely correct, okay? And that's because of the discount. That's because we saved a few bucks. So let's make this journal entry balance, okay? Utilities expense is going to decrease by $5.59. So what you see as we're constructing this payment is that the liability goes away completely. The cash payment is this lower amount because we accepted the vendor's discount. We only had to pay 98% of the invoice. And the balancing credit actually reduces our utilities expense, because you could see right here, if you net out the two items that I just circled, it's as if our net expense was only $273.76. Now, a bookkeeping note. Some companies might choose to credit an account called purchase discounts or some kind of contra account. And that certainly would be acceptable. But also in this case, it's a direct reduction of an operating expense, and I believe that would be acceptable as well in this case. Where you see the purchase discounts is more often when we're dealing with costs involved with inventory and ultimately cost of goods sold. But for this type of an entity right here, a vacation rental, this is simply a reduction of an operating expense. Now that's if we decide to take their offer. If we want to wait all the way until a month later, because it does say pay the net within 30 days, well, then the accounts payable balance still goes away. Right? So this part of the journal entry right here looks no different than what we have right here. And our cash goes away. It's just a little bit more cash because we have to pay the full amount. Okay. So what you can see is this is a good illustration of an accounts payable transaction where we incur an expense, where we potentially take a discount that's offered by our vendor, or if we choose not to take that discount. One of the goals of accrual accounting is for us to be able to measure the expenses that are incurred during a particular time period. And we want the expenses to be complete for that time period. We also want to match expenses in the same income statement period as the revenues that were generated by those expenses. Now, sometimes we need to use accrual accounts to get this done because it's possible to incur the expense in one period even though we're making payment for the expense in either a future period or maybe in the past. These are just a couple, I guess I should say a few examples of liabilities, expenses that have been incurred but not yet paid. Okay, it could be interest. We have borrowed some money from a bank or another lender, and every day that we borrow that money, we incur interest expense. even if the interest payment might happen at a later date. Payroll, very common on companies' books, because rarely does the end of a pay period coincide exactly with the end of a company's fiscal year. There's usually some stub, some difference where our employees worked for us for a period of time, but they're not going to get paid until next week or maybe 2 weeks from now. And we need to measure that expense in the current period. Taxes could be real estate taxes, could be personal property taxes, corporate income taxes, plenty of other taxes. If we incurred them during a particular income statement period and we want to match those expenses with the revenues, we may need to make an accrual. And really, any expense can be accrued. You pick the expense. If it's supposed to be on this year's income statement, but we didn't pay it yet, we need to accrue it. Now, of course, these could also be prepaids. That's a discussion for a different topic for a different discussion. But any of these expenses really could also be prepaid if we paid for the expense before the period began. But we're going to focus our discussion right here on what it means to accrue a liability, because we're going to make the payment in the future. Last note before we move on to a couple of examples is that sometimes you might see this as accrued payroll or accrued interest or accrued taxes. Other times you might see a caption where a company, for example, says interest payable or taxes payable. I believe that the word accrued is more generally accepted, but either one of those seems to be acceptable. It's a matter of preference how you're going to label those captions. What I would say is make sure that they are meaningful and that they accurately describe what's happening in the financial statements, and then use them consistently. So let's take a look at an example here involving real estate taxes. And we have to talk about a few key dates. In Michigan, where I live, real estate taxes are due on September 14 of any particular year. And happy Valentine's Day. I get to give a Valentine's Day gift to the state of Michigan, well, not to the state, to various local townships and cities every year. Wonderful, wonderful Valentine's Day gifts. So let's just look at a scenario here where this particular company has property taxes that are due the middle of September 2018, and then the next payment is due in the middle of February 2019. Right? Try to construct a realistic example. And let's assume that the annual real estate tax expense is $12,000. And you might assume by now, if you've watched any of my videos, I try to make the math easy. That comes out to $1,000 a month, guys, right? $12,000 a year. There's 12 months in a year, so we can very simply say that the average expense is $1,000 for each month. Let's explore the real estate tax payments that we just described. So this company receives a bill, sometime in probably June or July, probably July. They receive a bill from the local government and from the treasurer at that local government, and it says you need to pay us $7,000 on or before September 14. And they pay it. And then we've got this next bill. Now, they have not paid it yet, but the bill is for $5,000, and they expect to pay it right around April 14th. Okay? So these are the actual cash payment dates. Okay, so let's assume that the company, this bill that was due on September 14, they actually pay it August 31. No need to wait till the very last minute. So August 31, they pay this bill of $7,000, and that's covering the period from February 2018 through August 2018. So in other words, it's covering 7 months. So this payment properly includes 2018 expense on the income statement, but that's only for a portion. Okay. There is also going to be a portion in September, October, November, December that we need to capture. And we're presuming, of course, also that we captured the earlier months. What we're looking for here, guys, is for the annual property tax expense for this company to be $12,000 if that truly is what it cost on an annual basis. Now, of course, property taxes generally increase every year. I suppose they could decrease, but they generally increase a little bit each year. But we're just trying to keep this example simple. We're trying to get to $12,000 of expense for the annual period here. So what you're seeing is we get 7 months of the expense here. There would have been $1,000 earlier in the year for January 2018. We're going to assume that that's recorded appropriately. But what happens is this. We get to the end of 2018, and there are 4 months that have elapsed. Okay, these right here. This $1,000 per month for 4 months. So there's $4,000 of expense here associated with September, October, November, and December that simply is not going to get paid during 2018, okay? And then we're going to be making another payment over here in 2019. So let's look at what we have to do at the end of 2018. We need to record that property tax expense. Now, I'm going to use an account called property tax expense. There's nothing magical about that. You could choose real estate expense, or you could choose some other descriptive expense, as long as it's meaningful to you and it's clear to the people that are using the financial statements. So we're going to make a debit entry to property tax expense. What we're essentially doing is we're placing this expense on the income statement for the year ended December 31, 2018. But when we get to the credit entry for this transaction, it's not going to be cash, because we're not spending more cash. This cash is actually going to be part of a payment next year. So what we have to do is we're going to have an accrued expense. This is a current liability, okay, and we called it property tax, so we can call this property tax as well. Okay. So what you're going to see here is that instead of an asset called cash decreasing, we have a current liability called accrued property tax expense, or accrued real estate taxes, or maybe we even call it property taxes payable. But the takeaway is this: it's a current liability, and what this tells people when they look at our balance sheet is that, oh, this company owes $4,000 to one or more governmental entities for property taxes, and I can assume that they're going to have to pay that pretty soon, within the next year, probably sooner. Let's explore what happens now in 2019. So remember, this company had its summer tax bill that was due in September. They paid it in August. And there had been a previous winter tax bill that they had paid back in February of 2018. That's where we got the January expense. Now we get over here to 2019. And what we're seeing is this. There's a $5,000 bill. We're going to pay it, let's just say, on January 31 of 2019, a couple weeks before the due date. And what you're seeing here is still $2,000, okay? Okay. But think about when we're paying this, okay? And so what we probably want to do, and there are admittedly a couple different ways we could record this, but I'm going to look at it this way. On January 31, we make the payment to the government for these property taxes. So you already know it's going to be a credit entry to cash in the amount of $5,000. That's always pretty straightforward. Start with the easiest, most straightforward part of your journal entry. If you know that cash is going away, that's a really good starting point. Now, what needs to go away, remember over here at the end of 2018, we had accrued a liability, right? So what's happening is that liability that we had created and was listed on the balance sheet at the end of 2018, it's going away, because now we're actually paying the cash. Notice that we're not impacting the income statement by $4,000. We're just getting rid of a liability. We already recorded this $4,000 expense on last year's income statement, on the 2018 income statement. So we're simply getting rid of some cash and getting rid of a liability in the balance sheet. Now, of course, those of you who are astute will notice this doesn't balance. 4,000 does not equal 5,000. We need to debit something, And guess what that's going to be? That's going to be property tax expense, a portion of it for the current year. Remember how when we were looking at the 2018 transactions, I had indicated, oh yeah, they made this payment and this payment, and the January expense was recorded in a previous transaction. Well, now you're seeing that happening in the subsequent year. So in January, when we make the $5,000 payment, what that consists of is getting rid of the liability from the last 4 months of 2018, and then on the income statement, recording expense just for this month of January, and we're starting to fill out January's income statement. So by the time January is finished, our property tax expense for the 2019 fiscal year will be $1,000, and we know that we're going to have transactions similar to this and the accrual to fill out the rest of 2019 so that it will have a full year's worth of property tax expense. But that's a discussion for a different lecture, a transaction for a different day. That was accrued property taxes. Let's look at another common situation with accrued payroll. So we need to lay out the context for this company here. It's a restaurant, which means it's open on New Year's Eve. Okay, a lot of businesses may not incur payroll. Well, I suppose they still would with maybe holiday pay, but we actually have employees working on New Year's Eve. And another nuance for this company is that they pay every Monday. Now, I know that's a little bit unusual, but the reason I'm kind of pointing that out, and I'm just going to kind of color these in here. So the days that I'm coloring in, okay, we've got Monday, Tuesday, Wednesday, moving on to Thursday. All these days that I'm kind of just coloring in right here, okay? When Sunday has ended, the owners of the company tabulate the payroll, and then they pay the employees right here. Okay, so for example here, Monday, December 30, we will pay our employees for the amount of time that they spent working from Monday the 23rd until Sunday the 29th. Okay? I realize you probably get paid on Fridays, but trust me when I say that this is going to make the example just a little simpler to deal with here. So these days right here, this Monday through Sunday gets paid on the subsequent Monday right there. So what about these days right here? Okay. Monday and Tuesday. I told you that our employees will be working for us on those days, but they're not going to get that paycheck because we're going to have this day, and then Happy New Year all the way through here. Okay, so these days right here are going to get paid on Monday, January 6th. So we have to have a mechanism for capturing the cost of these 2 days and getting it into the 2019 financial statements so that we can have an accurate measure of our payroll for that period. Yeah, so let's put some numbers with this. So on Monday, the 30th, our employees earn $6,000. So in other words, all of our employees, we figure out the salaries and wages that were incurred that day. If we did pay our employees on a daily basis, this would be the payroll. And then we've got over here, maybe a little bit busier on New Year's Eve, and so people worked more hours, or maybe we had more staff on hand. But either way, we've got $14,000 worth of payroll expense over this 2-day period, and we need to have a way of getting that into the 2019 income statement. Well, what we're going to do, let's just start off with this. So the debit entry, I'm going to call it salaries and wages expense. Some companies might call it something different, but you might have multiple general ledger accounts, but you get what's going on there. This debit right here will place that expense onto the income statement. And we know there's going to be a credit. For every debit, there's a credit, or at least they're supposed to equal each other. But it's not going to be cash because we did not pay the cash yet. So how about we use an account called accrued salaries and wages. Some companies, like I said before, might call it salaries and wages payable, But either way, it's a current liability. Now, notice what this current liability has allowed us to do. It has allowed us to include this expense that is so important for us to have a complete picture of our payroll expense for 2019. It's allowed us to include that expense on the income statement, even though we did not pay the cash in 2019. We're going to pay it early in 2020. It might be interesting to take a moment and look at the accounting equation too. So if we look at this, what's happening is you have a liability, the accrual, increasing by $14,000. And then stockholders' equity will actually be decreasing because ultimately that expense, this extra $14,000, is going to reduce our net income, and that will ultimately reduce retained earnings, which is a component of stockholders' equity. So the effect of this single transaction in the accounting equation has no impact on assets. Liabilities go up by 14, stockholders' equity goes down by 14 because our profitability was reduced by $14,000. Let's fast forward to 2020. So what you can see here is that I've already pre-filled, but these are the days that our employees worked, and they're going to get paid on this day right here. So Monday, January 6th is payday. And what days does that cover? Covers these 2 days at the end of December, and it covers Wednesday through Sunday of the current week, so the beginning of 2020. Now, the total payroll, let's just assume that for the period, January 1, yeah, we're a restaurant, everybody's open. Okay. So from January 1, 2020, this date right here, all the way through January 5, the payroll is $25,000. Right. So over that 5-day period. And of course, we still have that liability. You might recall that over here, remember we had the $14,000 liability for those last 2 days in 2019. So let's construct the journal entry to make this payment to our employees. January 6th, we're going to pay them. And we can start out with the simple part if you'd like. I'm a fan of simple. Guess what the total payroll is going to be? It's going to be $39,000. Where am I coming up with that? It's simply the $25,000 for the current 5 days and combined with the liability from before. So we're gonna have to give our employees cash of $39,000 collectively. Well, one thing we know for sure is that we had accrued salaries and wages. That was the liability we had created back at the end of 2019. That liability is going away, okay? Because now we've paid the employees. This expense that was incurred in 2019, recorded as a current liability, now it's going away. So accrued salaries and wages goes to zero. And then the remainder of this, salaries and wages expense, it's appropriate to put that on the 2020 income statement because it's a payroll cost associated with 2020. The $25,000 incurred on these days, Wednesday through Sunday, that's an expense that belongs in the 2020 fiscal year. So it's okay to put that on the income statement, whereas the amount that's attributable to the previous year should not go on the 2020 income statement. It's already been reported on the 2019 income statement. So instead, we get rid of the liability. And then, of course, the cash goes away. Now, before we leave this transaction, there are two more things I want to do. I want to look at what happens to the accounting equation. So over here, overall, your assets are decreasing. Okay? Decreasing, in this case, by $39,000. And that's because your cash is going away. And then your liabilities are decreasing because we got rid of that accrued payroll account. We didn't get rid of the account, we zeroed it out. And then your stockholders' equity in this case is going to decrease by $25,000 for the same reason that stockholders' equity decreased when we accrued the payroll in 2018. That $25,000 is an additional expense. It will make our profit smaller. ultimately will make our retained earnings smaller. You can see that the accounting equation stays in balance. The liabilities and stockholders' equity portion decreases by $39,000 overall, and the assets decrease as well. One final note. This involves payroll. Payroll is arguably one of the more complicated transactions, one of the more complicated transaction cycles in the accounting process because so many things touch payroll. There are income tax withholdings, other types of payroll deductions. There are actually company matches of payroll tax expenses. There are payroll tax expenses that are only borne by the company itself. So payroll is a complicated animal, and it would be, I'm going to say never, okay? I don't like to say never, but I was going to say it's unusual, but never do employees receive the full cash amount of their compensation. So the reality is, if this were a real full-fledged business example, it wouldn't be as simple as this. We would not be crediting cash. We'd be crediting some liability accounts, some current liability accounts, because we would have payroll withholdings and other current liabilities, just for the reason that you don't receive your net paycheck. Your net paycheck is not equal to your gross paycheck, right? If you earn $1,000 at work, maybe you get a paycheck of $700 or $800. So those complications make payroll more difficult, and it makes this example not 100% realistic, but I'd like to stick with it for now because we're just trying to illustrate this one concept. Property taxes and payroll are just two of many examples of expenses that can be accrued. Any expense can be accrued if we need to place it on an income statement for the appropriate period and create a current liability to reflect our obligation to pay that liability. You see, accrued liabilities allow us to uphold the matching principle and place those expenses in the period where they were incurred, and sometimes we have to just reflect it with a current liability because the cash payment is actually going to happen at some point in the future.